Right now, Kenvue, ticker KVU, is trading at $16.14, and it is just barely in the red for the session, down about 0.12%. Now, if you just glanced at that quote, you would see a stock trading almost perfectly flat, maybe a little bit of profit-taking, and you would likely move on, assuming it's just another slow day for a boring consumer health company. You would be making a significant mistake. The expectation that today is just another session is completely wrong. The reality is that this flat price is an illusion, a mask. The entire future of Kenvue as an independent company has been completely upended in the last 24 hours, and this 16.14 price point is not the result of normal market making. It is the new artificial anchor point set by one of the biggest news items to hit the consumer sector this year. That 0.12% drop is meaningless. What is meaningful is the explosive 12 to 17% surge that happened yesterday on Monday, November 3rd, which is the sole reason the stock is sitting at this level at all. The entire narrative for Kenvue, the Johnson & Johnson spinoff that was supposed to be a safe, stable dividend-paying giant, has been one of failure since its 2023 IPO. Investors who bought into the story of iconic brands like Tylenol, Listerine, Band-Aid, and Neutrogena have been absolutely crushed. The expectation was stability. The reality was a stock that had lost nearly half of its value from its post-IPO peak, a CEO who was ousted in July amid this freefall, and the looming shadow of activist investors circling the wounded company, demanding change. The common belief was that Kenvue was a broken stock, a classic case of a spin-off failing to find its footing, burdened by slow growth and a lack of innovation. And then, yesterday, the change that activists were demanding finally arrived, just not in the way anyone expected. Kimberly-Clark, the maker of Kleenex and Huggies, announced it is acquiring Kenvue in a massive cash and stock deal valued at somewhere between $40 and $49 billion. This is the entire story now. Kenvue's life as an independent entity is over, pending regulatory approval. The stock is no longer trading on its own fundamentals. It is now an arbitrage play, its value permanently tethered to the terms of this acquisition agreement. The market's reaction tells you everything you need to know. Kenvue stock soared on the news, not because Kenvue is suddenly a great company, but because it's being bought out. Conversely, Kimberly-Clark stock absolutely cratered, slumping by nearly 15%. The market believes Kimberly-Clark is either overpaying or, more likely, catching a falling knife by acquiring a company with deep systemic problems. This isn't a merger of equals. This looks like a rescue. And to make the timing even more dramatic, this news dropped at the exact same time as Kenvue's third quarter earnings report. And what did those earnings show? They confirmed every fear that investors had. The earnings were, in no uncertain terms, terrible. Net sales were down 3.5%. More importantly, organic sales, the true measure of health, fell by 4.4%. This was driven by a 4% decrease in volume. People are buying less of their products. The company blamed a variety of factors: shipment timing in China, trade inventory reductions, and a slowdown in category growth. But the numbers are the numbers. They also affirmed a weak outlook for the full year, expecting sales to be down in the low single digits. In a stunningly telling move, Kenvue's earnings release also included a small note. The company would no longer be hosting its previously planned quarterly conference call with investors. There was simply no point. The book is closed. The future is no longer about Kenvue's turnaround strategy. The future is about Kimberly-Clark's integration plan. So what does this mean for you if you're looking at this stock? The old catalysts are gone. The old risks are irrelevant. The risk of the J&J share overhang, which was a huge talking point as Johnson & Johnson was systematically selling off its remaining stake, is now completely moot. J&J will be bought out just like every other shareholder. The risk of Kenvue's poor execution and high cost structure, that is now Kimberly-Clark's problem, and the market is punishing their stock for it. The new reality is this. Kenvue's stock price will now live and die by two factors and two factors alone. First, the perceived likelihood of the deal successfully closing, and second, the fluctuations in the value of Kimberly-Clark stock, since a portion of the deal is stock-based. The biggest hurdle by far is regulatory approval. This is a massive consolidation in the consumer health space. You're talking about putting Tylenol and Kleenex, Band-Aid and Huggies, Listerine and Kotex all under one single corporate roof. Regulators in Washington, who have been increasingly hostile to large-scale mergers, are going to look at this deal with an extremely fine-toothed comb. This is the new primary risk. The second major factor is time. The companies are not expecting this deal to close until the second half of 2026. That is a long time for a stock to trade in limbo. A lot can happen in the broader economy and in the regulatory environment between now and then. So while yesterday's pop was a welcome relief for long-suffering shareholders, it's not the end of the story. The stock is simply entering a new, long phase of acquisition-based purgatory. This also completely changes the conversation around short interest. For months, the thesis for betting against Kenvue was simple. The company was a low-growth, poorly executing spin-off that was failing to innovate and was losing market share to cheaper private label brands. The dismal third-quarter report, with organic sales down 4.4%, was a massive vindication of that thesis. However, the short interest data itself was never explosive. Recent data showed short interest at only about 1.52% of the float. The borrow fee, which is the cost to borrow shares to short them, was also incredibly low, at last check around 0.27%. This tells us that this was not a crowded trade. It was not a meme stock short. It was a fundamental, slow bleed bet that the company's valuation was too high for its weak performance. When the acquisition news hit, that fundamental thesis was instantly vaporized. It no longer matters if Kenvue sales are weak. It no longer matters if their new product pipeline is thin. The price is now set by a buyer. Any short seller who was still in the trade likely covered their position immediately, probably taking a significant loss on that 12% gap up. This is and never was a short squeeze play. There is no army of shorts to beat. The days to cover was already incredibly low, at less than 1 day. The actionable insight here is to understand that the short-selling chapter for Kenvue is over. Anyone trying to initiate a new short position now is no longer betting against Kenvue's fundamentals. They are betting on the acquisition failing. That is a completely different and far more complex binary bet on regulatory action, not business performance. What's your take on this acquisition? Is Kimberly-Clark getting a bargain on iconic brands, or are they catching a falling knife? This new reality has sent a shockwave through the retail investor community. On forums and social media, the frustration from those who bought Kenvue at its IPO, believing in the safe dividend pitch, has been palpable for over a year. The stock was often derided as a boomer trap, a falling knife that perpetually disappointed. Yesterday's news brought a wave of relief, but now a new, more complicated debate has emerged. What do you do now? Do you sell into this strength, taking the 12% pop as a gift and running? Or do you hold your shares for the next year and a half, waiting for the deal to close? Holding on means you are betting that the deal will be approved and that the final cash and stock value will be worth more than the current $16.14. It introduces a new set of risks. This is the central conflict now for every Kenvue shareholder. Comment below if you are a Kenvue shareholder. Are you holding your shares through the acquisition, or did you sell on yesterday's news? So, as we watch Kenvue trade flat at 16.14, we have to look past the ticker. The expectation was that this company was on a slow, painful, multi-year path to either stabilize or continue its decline. The reality is that its story as an independent company is over, barely 2 years after it began. It was a company in deep trouble, confirmed by its own dismal earnings report, and it has been bought by a larger rival who is now being punished by the market for doing so. The future for Kenvue stock is no longer about its PE ratio, its dividend yield, or its organic growth. It is now about the fine print in a merger agreement and the political decisions of regulators. The game has completely changed.